right now, the artificial intelligence revolution is like physically running out of glass.
Yeah, literally.
And it's hitting this very hard, very hot wall of copper. Because if you look at the headlines, I mean, the entire market is just completely fixated on the software layer.
Right. The software gets all the glory.
Exactly. We obsess over, the parameters of the latest large language models or the latency of generative video or the inference capabilities of the newest chatbots. We throw around the term the cloud as if all of this compute is happening in some, weightless, ethereal dimension. But if you actually look at the capital expenditures of the major hyperscalers.
The cloud is incredibly heavy.
Yes, it is brutal. Physical infrastructure. It is forged from rare earth metals, silicon, and like tens of millions of miles of perfectly engineered optical glass.
It's a really crucial disconnect in the market right now because, the software gets the valuation premiums and magazine covers, but the physical layer, the actual plumbing that allows a cluster of, say, 100,000 GPUs to talk to each other fast enough to train these models.
Which is the whole point of the investment, yeah.
Exactly. Well, that is where the real architectural bottlenecks are emerging. I mean, if the data cannot move out of the server rack, your multi-billion-dollar GPU investment just sits idle.
Which brings us to today. Welcome to this edition of The Deep Dive. Today, we are putting our investor hats firmly on. We are running our Talk Tickers format for you, and our specific mission is to break down the Q2 2026 earnings call from Lumentum Holdings Inc.
Ticker symbol, LITE.
Right, LITE. For those of you managing hardware or semiconductor allocations in your portfolios, you probably already know the stakes here. Lumentum is outright declaring itself a foundational engine of the AI revolution.
Which is a bold claim.
It is. That's a direct quote from management, actually.
Okay.
They're claiming that virtually every single AI network currently operating is reliant on their optical technology.
Whether that's directly through partnerships with the hyperscalers or, as a critical component supplier for the major network equipment manufacturers.
Yeah, it's an aggressive posture, but they're backing up with numbers that are, frankly, forcing a complete recalibration of their valuation model.
Oh, absolutely. In a hardware ecosystem that's prone to extreme cyclicality and endless corporate hype about AI adjacencies, the only truth you can rely on is in the ledger.
The numbers don't lie.
They don't. And Lumentum's ledger this quarter is telling a massive structural story about a fundamental shift in the physical infrastructure of artificial intelligence.
So, as usual with Talk Tickers, we are going to be data forward, highly opinionated, and totally actionable. We're skipping the 101 level definitions today. We're diving straight into the engineering and the unit economics.
Let's do it.
So let's open up the ledger and look at what Lumentum actually delivered for Q2 2026, because these headline numbers suggest a company that is fundamentally broken out of its historical revenue bands.
Yeah, let's look at the top line first. For Q2 of fiscal 2026, Lumentum reported a record-breaking $665.5 million in revenue.
Which is just massive.
It prints at the very high end of their previous guidance range, and it represents a year-over-year growth rate of over 65%.
A 65% top-line expansion for a capital-intensive hardware manufacturer. You have to understand, that is not normal cyclical telecom growth.
Not at all.
That is hyperscaler-driven demand, basically pulling forward their entire roadmap. And if you segment that out, their components revenue hit $443.7 million, which is up 68% year over year.
And systems revenue reached $221.8 million, up 60%. So they're scaling both the raw materials and the integrated boxes simultaneously.
Right. But, top line beats in this specific AI environment are almost expected. Everyone is selling more stuff.
True.
Where Lumentum separated themselves this quarter, though, is the bottom line.
The leverage they demonstrated is genuinely staggering. Non-GAAP earnings per share came in at $1.67, which just obliterated the consensus estimates.
Wait, what was the GAAP EPS, just for context?
Right? For context on the underlying reporting, GAAP EPS was $0.89.
Got it.
But the metric that really dictates the structural health of this business, and frankly, the reason the market is repricing the stock, is the margin expansion. Non-GAAP gross margin reached 42.5%.
Okay, stop right there. 42.5%.
Yeah, that's a sequential expansion of 310 basis points from Q1. But more importantly, it's an expansion of 1,020 basis points year over year.
Okay, that gross margin leap is impressive, but the operating leverage is where the story actually lives. Non-GAAP operating margin hit 25.2%. That is a 1,730 basis point increase year over year, which leads to an operating profit of $167.7 million.
It's incredible.
Let's dissect the mechanics of that 1,730 basis point jump, because I want to translate this Wall Street jargon for you. Basically just mean hundredths of a percentage point. So 700 and something basis points is a 17.3 percentage point jump.
Right.
In a manufacturing business heavily reliant on clean rooms and complex fabrication facilities, a 17 percentage point operating margin expansion implies a massive shift in either fixed cost absorption or core pricing power.
You don't get that just by selling more of your legacy product mix.
Exactly. If I run a t-shirt shop and my operating margin jumps by 1,700 basis points, it's like I suddenly figured out how to sell the exact same cotton shirts for double the price without my rent going up at all.
That's a great analogy.
How did they achieve this kind of leverage?
Well, management pointed to a few interconnected factors, starting with rigorous cost controls. They have held their operating expenses relatively flat while absorbing this massive top-line surge, which naturally creates operating leverage.
You're keeping the rent flat while selling more shirts.
Exactly. But the dominant driver, the real engine of that 17 percentage point jump, is mix improvement and direct pricing power.
Meaning they are aggressively prioritizing the production of higher margin next-generation components over their older legacy telecom gear.
Yeah, precisely. The prime example from the transcript is the data center laser chip segment. Specifically, the components engineered for 200 gig lane speeds.
Right.
These are the cutting-edge, edge-emitting lasers required for the newest generation of AI clusters. And management highlighted a really fascinating metric here.
Oh, the volume versus revenue stat?
Yes. Those 200 gig chips represented only about 5% of their total unit volume shipped this quarter.
Just 5%.
But because the performance requirements are so extreme and the yields are notoriously difficult to master across the industry, Lumentum commands a massive premium for them. That 5% of physical volume generated roughly 10% of their data center laser chip revenue.
Wow. It just perfectly illustrates the dynamic of the optical hardware market right now.
Yeah.
The hyperscalers are not price sensitive when it comes to density and speed.
Not at all.
If you can deliver a 200 gig lane that actually meets their power and thermal envelopes, they will pay whatever premium you ask. Because, the alternative is bottlenecking a billion-dollar GPU cluster over a tiny laser chip.
Right, and the margin implication for Lumentum there is profound. They noted on the call that they expect this 200 gig mix to climb from 5% up to 20%, or even 25% by the end of the calendar year.
Okay, think about that math for a second. If they are printing 42.5% gross margins right now, with 200 gig chips at only a 5% mix, the margin trajectory as that mix quintuples to 25% is incredibly bullish.
The fixed costs of their indium phosphide fabs remain relatively stable, so every incremental 200 gig wafer they manage to yield drops almost straight to the bottom line.
And furthermore, management openly stated they have instituted increased pricing on select products across the board due to the sheer velocity of demand. Like, the market is currently inelastic enough that Lumentum is raising prices, and customers are simply absorbing it just to secure their allocation.
Which forces us to look past the financial metrics and examine the physical hardware driving this inelasticity.
Right, the transition from the what to the why.
Exactly. The 65% revenue growth and the margin explosion are lagging indicators of product architecture wins. When we look at what is physically flying out of their clean rooms, 3 specific product categories are really dominating the narrative.
Let's start with what management called the good news story of the quarter.
The optical circuit switches, or OCS.
Yeah, they completely blew past their internal projections here. They had originally targeted crossing the $10 million quarterly revenue threshold for OCS in their fiscal third quarter. They cleared that milestone 3 months ahead of schedule. But the leading indicator, the real story, is the order book.
The backlog.
Yes, the OCS backlog has surged past $400 million, with CEO Michael Hurlston noting the vast majority of that is slated to ship in the second half of the calendar year.
And to understand why a $400 million backlog for OCS is so critical, we have to look at data center architecture.
Break it down.
Historically, when data moves through a network, it constantly undergoes these optical conversions. Right. The light comes in through a fiber, gets converted to an electrical signal so the switch silicon can process it, and then is converted back to light to continue its journey out the other side.
And every one of those conversions consumes massive amounts of power and adds latency.
Yes. And power, as we know, is the single biggest constraint in AI data centers today.
Right. They aren't constrained by compute. They are constrained by the local utility grid. Like they physically can't draw enough electricity.
Precisely. So what an optical circuit switch does is remove that electrical conversion entirely.
Why?
It uses highly complex microelectromechanical systems, MEMS arrays, which are essentially thousands of microscopic mirrors on a silicon chip.
Microscopic mirrors.
Yeah. When a signal needs to be routed, the physical mirrors literally tilt at microscopic angles to bounce the beam of light directly into the correct output fiber.
That is wild.
Yeah. It remains entirely optical. It is completely passive. It consumes a fraction of the power of a traditional electrical switch. For a hyperscaler trying to provision, say, a 100 gigawatt AI cluster, deploying OCS isn't just an upgrade.
It's a fundamental requirement.
It's a requirement to keep the power budget from breaking.
So they hit the 10 million run rate early, and they have 400 million in demand locked and loaded for the back half of the year. That alone changes the top line trajectory.
Absolutely.
But the second major growth driver is their cloud transceiver business. This is like the bread and butter of data center optics, the actual pluggable modules that convert the signal at the server edge.
And we are currently witnessing an industry-wide architecture transition to 1.6T speeds.
Right. And the jump from 800G to 1.6 terabits per second is pushing the physical limits of current modulation techniques. Lumentum management stated on the call that they are now firmly entrenched in the lead pack of suppliers for this 1.6T transition.
They aren't just a secondary source anymore.
Exactly. They are securing primary design wins for the core transceiver infrastructure. And they noted that this segment significantly outperformed their legacy cloud run rates, which proves that the bleeding edge AI demand is more than offsetting any softness in traditional cloud networking.
Then there is the third driver, which is a bit further out on the timeline, but perhaps the most strategically important of all.
Co-packaged optics, or CPO.
Yes. They just announced a brand new multi-$100 million purchase order specifically for ultra-high-power lasers engineered for CPO, with initial deliveries slated for the first half of calendar 2027.
And co-packaged optics is sort of the holy grail for hardware engineers right now, isn't it?
It really is. Instead of having the optical transceiver sitting at the front faceplate of the server rack, pushing the electrical signal across inches of the motherboard to reach the ASIC,
which takes power and generates heat.
Exactly. CPO moves the laser right next to the compute silicon on the exact same substrate.
So it drastically reduces the electrical trace distance.
Yes, which solves immense signal integrity and power dissipation issues. The fact that Lumentum is already locking in multi-$100 million purchase orders for 2027 delivery basically validates that their laser technology is being architected directly into the next generation compute platforms.
The hyperscalers are making their long-term bets on Lumentum's specific laser implementations today.
Exactly.
Okay, so you have OCS demand going vertical with a 400 million backlog. You have cloud transceivers dominating the 1.6T upgrade cycle, and you have massive 2027 visibility via CPO.
It sounds like an impenetrable fortress of growth.
It does, but, and I have to stop you here, because there is a glaring mechanical constraint in this transcript, and it presents a massive execution risk.
The capacity issues.
Yes. Lumentum's internal indium phosphide wafer fabs, the highly specialized facilities where they actually grow and etch these laser chips, are completely sold out.
Right.
Even after front-loading their capital expenditures and bringing 20% more fab capacity online this past quarter, management openly admitted they are still undershipping customer demand by roughly 30%.
And undershipping by 30% in a hyperscaler-dominated market is an inherently dangerous position.
I mean, wait, I have to push back on the market's optimism on this specific point. If you are 30% short of what your customers actively want to buy right now, isn't that a massive risk? You are literally leaving money on the table.
It's a huge risk.
But worse than that, in the semiconductor ecosystem, if you cannot guarantee supply, your customers will aggressively fund your competitors to ensure they have second and third sources. Are they bottlenecking their own growth?
Your assessment of the risk is totally accurate. I mean, supply constraints are the death knell of hardware monopolies. However, you have to analyze how Lumentum is leveraging this specific supply-demand imbalance.
How so?
We are currently in an unprecedented seller's market for AI infrastructure. Lumentum recognizes that their customers cannot simply pivot to a secondary supplier because the secondary suppliers are also sold out.
Oh, right.
And their yields on these 200 gig chips are often inferior anyway. So Lumentum is using this 30% supply deficit strategically via two major structural shifts in their business model.
The first being their deployment of long-term agreements, or LTAs.
Exactly. Historically, the optical component market was fiercely tactical. Customers would operate on short-term purchase orders, constantly playing suppliers against each other to drive down prices every single quarter.
It was a race to the bottom for margins.
Totally. But today, because the hyperscalers are terrified of missing their AI roadmap deployments due to component shortages, Lumentum is forcing them to sign guaranteed multi-year LTAs extending well through 2027.
So they're entirely flipping the script. They are trading spot market capacity today for structural revenue certainty over the next 3 years.
Yes.
They are basically removing the cyclicality from their fab utilization.
It fundamentally changes the risk profile of the stock. Every single wafer coming out of their indium phosphide fabs is spoken for. And the nuance of these LTAs gives Lumentum immense pricing power.
How does that work in practice?
Well, if a hyperscaler suddenly realizes they underestimated their AI build-out and needs volume above their allocated LTA baseline.
Which is happening constantly right now.
Right. Lumentum uses that desperation to negotiate severe premiums for those incremental units. They have secured their baseline cash flows while retaining massive upside leverage on the incremental demand.
Okay, that is aggressive and highly effective financial engineering, but it doesn't solve the laws of physics.
No, it doesn't.
LTAs secure the revenue, but they still have to physically manufacture the chips. If you are 30% short on capacity, you have to build more capacity. And expanding an indium phosphide clean room isn't something you do in a quarter.
Which brings us to their second strategic maneuver. The pivot to heavy contract manufacturing.
Right.
They actually brought in a new executive specifically from Jabil to oversee a massive offloading of their back-end operations.
They're heavily leaning into Jabil's Nava facility in Thailand. The strategy, as I read it, is to bifurcate their manufacturing process. Lumentum retains the ultra-complex, high-margin front-end wafer fabrication inside their proprietary fabs in the UK and Japan.
That is the secret sauce.
Right? Growing the indium phosphide boules and etching the epitaxial layers. But they are taking the back-end processes, the testing, the packaging, the integration of the chips into modules, and moving that all to Thailand.
The theory being that if you move the less complex, highly labor-intensive packaging work to a massive contract manufacturer like Jabil, you free up vital clean room floor space in your internal fabs.
To produce more high-margin raw wafers.
Exactly. It expands your bottleneck without requiring you to build $1 billion greenfield fab from scratch.
That is the operational theory. And it is really the only viable path for them to close that 30% supply gap in the near term. But, as we'll discuss later, transitioning optical back-end manufacturing is fraught with yield risks.
Oh, heavily fraught.
It's not just snapping Legos together, right? Optical packaging requires sub-micron alignment.
Yeah, it's incredibly delicate work.
But assuming they execute on this Thailand transition, the current pricing power and the expanding capacity are setting up a phenomenal forward-looking picture. Let's look at the management guidance, because the projections for Q3 2026 suggest this quarter was really just the baseline.
The Q3 guide is where the sheer scale of this AI infrastructure build-out becomes glaringly apparent. Management guided for net revenue between $780 million and $830 million.
Wow.
The midpoint of $805 million represents a year-over-year revenue increase of more than 85%.
85%.
It will completely obliterate their previous all-time records.
And to contextualize how rapidly this business is accelerating for you, Lumentum previously provided Wall Street with an internal target model indicating they expected to cross the $750 million quarterly revenue mark sometime in mid-calendar 2026. With this Q3 guide, they're going to smash that target a full quarter early. And not just beat it, but potentially clear it by $50 to $80 million.
The demand is pulling their financial roadmap forward at an unprecedented rate.
And the margin expansion we analyzed earlier is projected to continue its upward trajectory too.
Yes, management guided for Q3 non-GAAP operating margins to expand into the 30% to 31% range, driving projected EPS to between $2.15 and $2.35.
So that 17 percentage point jump wasn't an anomaly at all.
No, it was the beginning of a new structural margin baseline for the company.
But, beyond the raw numbers, CEO Michael Hurlston, dedicated a significant portion of the earnings call to detailing a technological inflection point that every hardware investor needs to internalize.
He called it a generational game changer.
He did. And it centers around the physics of data center architecture, specifically the battle between optical scale-out and optical scale-up.
This is the crux of the long-term thesis for Lumentum. To really understand scale-out versus scale-up, you have to look at the physical layout of an AI data center.
Okay, lay it out for us.
Scale-out refers to the network connections that link different server racks together across the data center floor, or, link entire data center buildings across a massive campus.
These are relatively long distances.
Right, meters to kilometers. For years, scale-out has been entirely dominated by optics. Lumentum already owns this space. Their transceivers and lasers provide the highways between the server racks.
But the inside the server rack is a completely different domain.
Completely different.
Scale-up refers to the highly dense, ultra-fast connections between the individual GPU chips and the switch silicon within a single rack. Historically, because the distances are so short, maybe a meter or less, the industry has relied entirely on copper wiring.
Because copper is cheap, it's reliable, and it doesn't require complex electro-optical conversion.
But copper is fundamentally bound by the laws of physics, specifically regarding high-frequency signal attenuation.
Right. As AI clusters demand faster data transfer rates, pushing past 200 gigs per lane and approaching 400 gigs per lane, the electrical signals traveling through copper degrade rapidly.
The impedance creates a massive, what do they call it, skin effect.
Yeah, the skin effect, where the signal struggles to propagate. And more importantly, the power required to force that signal through the copper generates an unsustainable amount of heat.
The copper literally acts as a heater inside an already thermally constrained GPU rack.
It's a huge problem.
Management was unequivocal on the call. Copper is hitting a hard physical limit. Lumentum projects that by late calendar 2027, the industry will pivot aggressively to scale up CPO. They're going to rip out the heavy copper plumbing inside the racks and replace it entirely with high-speed optical fiber.
The implications for Lumentum's total addressable market are just staggering here.
So scale out is like the interstate highways connecting different cities, and they already own the highways.
Right.
But scale up means they are now coming into the actual buildings, ripping out the old copper plumbing and replacing it with their high-speed fiber. They are entirely expanding their addressable market.
That's a perfect analogy. They are no longer just fighting for market share on the data center floor. The floor plan itself is doubling in their favor. By bringing optical interconnects directly to the GPU inside the rack, they are expanding into a massive legacy market previously entirely walled off to them by copper vendors.
And they are executing this invasion strategically. They aren't just planning to sell bare laser chips to the companies building these new optical server racks.
No, they're actively expanding their product portfolio into pluggable external light source, or ELS, modules.
Right. And this is a critical distinction for their long-term margin profile. With an ELS module, Lumentum is offering a complete turnkey subsystem.
Exactly. They are taking their proprietary indium phosphide lasers, integrating them with the necessary control circuitry, the cooling mechanisms, and the optical alignment components.
And packaging it all into a single plug-and-play module that powers the co-packaged optics.
They are capturing the value of the integration rather than just the value of the raw material.
And the economics of that integration are incredible. Management explicitly noted on the call that selling a completed ELS module commands an average selling price, an ASP, roughly 2 to 2.5 times higher than selling the raw laser chips alone.
Wow.
So they are not only invading the massive copper scale-up market, they are doing so with a product architecture that inherently doubles their revenue per unit deployed.
When you synthesize the Q3 guidance of 85% revenue growth, operating margins crossing 30%, the physical depth of copper in the server rack, and a product strategy designed to extract 2.5x higher ASPs via modular integration, the narrative is extraordinarily potent.
Which brings us to the core of the Talk Tickers mandate. The bottom line. Based on the deep read of this Q2 2026 transcript, the underlying physics of the product roadmap, and the unit economics of their fab utilization, we are taking a definitive, structurally bullish stance on Lumentum.
Unquestionably bullish. The bull case is anchored by 3 undeniable catalysts.
Let's hear them.
Number 1, unprecedented visibility. In the hardware sector, visibility is notoriously poor. Orders evaporate the moment macroeconomic headwinds appear. But Lumentum is operating with a level of revenue certainty that mimics a SaaS company.
Through the LTAs.
Right. Through the enforcement of strict long-term agreements, their front-end fab capacity is essentially locked and monetized through 2027. When you combine that with the $400 million OCS backlog and multi-$100 million CPO commitments, the revenue floor is concrete.
Catalyst number 2 is the structural margin expansion. Accelerating revenue is totally irrelevant if the unit economics are degrading.
Right, profitless growth.
Exactly. But Lumentum is proving they can scale profits aggressively faster than revenue by leveraging the immense pricing power of their ultra-premium 200 gig chips and pivoting their product mix toward highly integrated ELS modules. They are permanently elevating their gross margin profile into the 40s.
And pushing operating margins past 30%.
Right. This isn't just growth. This is highly profitable, defensible growth.
And catalyst number 3, monopolizing AI infrastructure. They are not merely reacting to the current cycle, they are actively architecting the next generation of data center topologies.
By dominating the 1.6T design cycle.
Yes, and positioning themselves as the foundational technology for optical scale-up inside the server rack.
Yeah.
They are rendering themselves indispensable. As copper fails, Lumentum's silicon and glass become the only viable pathway for AI cluster scaling.
Okay, the bull case is fundamentally sound, but our mandate is also to be highly objective. I'm not going to let this analysis conclude as a purely promotional exercise for Lumentum management. I want to scrutinize the risks. If we fast forward 18 months and the stock has suffered a massive drawdown, what will we look back at in this transcript and identify as the obvious warning sign we ignored? Where are the fractures in this foundation?
There are 2 primary risk vectors that demand close monitoring. The first is macroeconomic and involves their legacy business segments. While the AI and cloud revenues are exploding, management did acknowledge that their industrial end markets remain cyclically soft. Lumentum operates a significant industrial laser business for things like cutting, welding, and macro machining applications.
And right now, that industrial softness is being entirely camouflaged by the hypergrowth in data center optics.
Exactly. However, if the AI capital expenditure cycle were to suddenly decelerate or plateau, that stagnant industrial segment would immediately become a massive drag on overall corporate margins and growth rates.
It's the classic trap of a diversified hardware manufacturer. The high-flying segment hides the anchor until the wind stops blowing.
Very true.
That is a valid structural risk.
Yeah.
But what is the acute risk directly tied to the AI growth engine itself?
The acute risk, the one that could derail them in a single quarter, is pure execution risk regarding their manufacturing transition. We discussed how their internal front-end fabs in the UK and Japan are completely tapped out.
Right.
And how they are attempting to solve this 30% supply deficit by aggressively migrating back-end testing and packaging to Jabil's Nava facility in Thailand.
And this is where the physics of optical engineering clash with the realities of contract manufacturing. We're not talking about stamping out plastic consumer electronics here.
Exactly. Optical packaging requires aligning microscopic fibers to laser diodes with tolerances measured in submicrons. It is an incredibly delicate, highly specialized process.
And historically, Lumentum controlled this entirely in-house because the yield curves are so sensitive to environmental anomalies.
Yes. Tech transferring a process of that extreme complexity to a third-party contract manufacturer halfway across the world is fraught with peril.
If Jabil struggles to ramp the yields at the Nava facility, Lumentum's entire strategy bottlenecks. I mean, it doesn't matter if you have a $400 million OCS backlog or ironclad long-term agreements. If you physically cannot ship the completed modules because your contract manufacturer is failing test protocols,
The hyperscalers will not wait.
Exactly. If Lumentum stumbles on this execution, those LTAs will be subjected to brutal penalty clauses, and competitors will be invited in to fill the void.
It is the ultimate high-wire act. They are attempting to execute a complex global manufacturing pivot while running at 100% capacity utilization amidst the highest demand cycle in the history of the company.
Right.
In the upcoming quarterly calls, the metric to watch isn't just the revenue beat. It is any subtle management commentary regarding, yield optimization or ramp delays at Nava or back-end packaging constraints. If those phrases appear, the execution risk is materializing.
That is exactly the nuance investors need to track. They have the roadmap, but they have to physically build the road without tripping over their own supply chain. As we wrap up this deep dive, there is one final overarching dynamic I want to leave you pondering. It relates to the nature of technological disruption.
The zero-sum game of architecture transitions.
Exactly. In the history of hardware investing, every time a new disruptive technology wins a market, an old legacy technology dies. We spent a significant amount of time detailing the physics of scale-out versus scale-up. If Lumentum and its optical peers successfully execute this roadmap, and optical scale-up physically invades the server racks by 2027, eventually subsuming all copper interconnectivity, as management explicitly predicts. What is the downstream casualty?
The downstream casualties are the massive, entrenched legacy companies whose entire corporate valuations rely on manufacturing, extruding, and selling heavy copper cabling and the associated electrical connectors.
Yes. When you review your portfolio allocations in the wake of an earnings call like this, your analysis shouldn't stop at buying the victor. You have to actively identify the losers.
It's just as important.
During a gold rush, it is highly profitable to buy the companies selling the pickaxes. But you must also ensure you aggressively divest from the company trying to sell wooden shovels. If optical scale-up is the inevitable future of the AI data center, make absolutely sure you aren't holding the equity the company is still trying to sell the copper.
A vital perspective. Innovation creates immense value, but it is inherently destructive to the old guard.
Thank you for joining us for this rigorous Talk Tickers breakdown. Keep scrutinizing the physics behind the financials. Maintain your objectivity regarding execution risks, and always read past the headline numbers. We will catch you on the next deep dive.